Assignment 8, we look at three major portions of financial statement reporting: fixed assets, debt, and leases. Now, there are two components to this assignment. One is the Excel spreadsheet, the other is the actual Word document where we'll answer some questions. Now, when you go to complete the Excel worksheet, I've included some notes on each one of the pages to help you complete this document appropriately. So be sure you look at the notes that are included, and then in the case of most of the items, look to the financial statements to see if there's a footnote that helps you with the information. You might find a footnote that has a detailed analysis of property, plant, equipment, one that has information regarding leases, and then one maybe might not say debt, but it might say long-term obligations and borrowing arrangements, which is the same thing as saying here's debt. So look beyond the basic financial statements to the footnotes. Again, additional disclosure, explanations that management must provide regarding the information contained in the financial statements. And then complete the worksheets using the additional information that is provided in those sheets regarding what should be included in the Excel worksheet. Now, the Excel worksheet provides the basis for answers to a lot of the questions in the Word document. So when you go to the Word document, be sure you've completed the Excel worksheet first. For the most part, the questions that relate to fixed assets in the Word document are fairly straightforward. There is one that asks about how the percentage of assets depreciated has changed this year versus the prior year. So look at that, and then using your knowledge of what depreciation means from a standpoint of what does it represent in the financial statements. In other words, it's a recording of the usage of fixed assets in the production of revenue. And again, following the matching principle to say, all right, we want to match the cost of revenue production with the actual revenues themselves. So if assets are more depreciated or less depreciated this year versus last year, what caused that change? Did we buy more assets than the depreciation? Did we not buy as many assets, and so therefore the percentage of assets that are depreciated has increased? What does that mean to the company as a whole? Now, one of the things that this assignment does ask you to do is look at capitalized leases. Now, remember, capitalized leases are those leases that meet certain criteria under GAAP and are recorded as debt and assets rather than the lease payments being expensed as incurred. And so those type of leases are in essence debt, and that's what GAAP considers them, even though on the face of the actual document it says this is a lease. The accounting for that is different than what you would typically find. Now, there'll be footnotes that give you this information, and so again, look to the lease footnotes to help you determine what that information is, and to include the amounts appropriately in the assignment worksheet. Now, there's also operating leases. Those would be those leases that do not meet the criteria for capitalization. And so calculate those amounts or determine those amounts again from the financial statements themselves. Now, there is a in the in the Excel document, there is a worksheet on what would be the effect of capitalizing all the operating leases. Now, there are a lot of accountants that believe that all leases, in essence, should be capitalized because they, in essence, represent a means of financing or incurring debt. And so that's what that worksheet does. It says already if we took all of the leases that are classified as operating leases and we, in essence, recorded them as debt, what would be the impact on the financial statements? Now, that impact would be, if you stop and think about it, we're going to increase the amount of recorded debt. We're going to increase the amount of assets recorded. And so, what's the impact on return on equity, return on assets? And again, on that worksheet, there's some very detailed explanations of how you derive the amounts included on the Excel worksheet. So use that Excel worksheet again to answer these questions as to what the impact would be on the financial statements of capitalizing these operating leases. Now, the last part of this is long-term debt information. You're asked to identify the five debt instruments that the company has. Now, list the largest ones as far as dollar value is concerned, and then what are the contractual arrangements relating to this debt, and in what year disclosed in the financial statements does the company have the largest commitment to make debt payments. Now, again, the reason that this disclosure is made is we're looking at, when we are looking at an investment, we're looking at the ability of the company to generate cash flows and be profitable in the future. In other words, we're going to make the investment today, but the return is going to be sometime in the future. And so companies need to disclose what kind of commitments they have made to the use of cash in the future. And again, the way they do that is through disclosure of future lease payments, future debt payments, and any other commitments that they've made. And generally, these disclosures are made for 5 years past the date of the balance sheet to give investors a long enough period of time to really assess the impact of commitments presently made and how they will impact the ability of the company to provide cash in the future. Okay? Now, as usual, should you have any questions, please send me an email. Thank you.